Good afternoon. My name's Liz Moran and I'm Director of Education and Research at FIIG Securities. Very delighted today to have Dr. Michael Drew with us. Michael is our Director at Drew, Walk & Co., a boutique firm of consulting financial economists. He co-founded with longtime friend and colleague Dr. Adam Wall. He received his PhD in the field of economics from the University of Queensland. Michael has written and lectured extensively on Australia's superannuation system and defined contribution pension plans. Dr. Drew has authored over 60 scholarly articles and his work has been cited in various international agencies and reviews, including the Cooper Review, International Monetary Fund, Productivity Commission, US Government Accountability Office, US Securities and Exchange Commission, US Hearing Senate before the Special Committee on Ageing and the World Bank. Dr. Drew delivered invited testimony to a joint hearing of the US Department of Labour and the US Securities Exchange Commission on target date funds and has been an expert witness on superannuation matters. In his role with Drew, Walk & Co., Michael is involved in matters relating to superannuation, portfolio construction and fiduciary governance. Michael is an adjunct professor at Griffith University and an honorary fellow in investments at Macquarie University. He is a fellow of the Australian Institute of Management and the Governance Institute of Australia and a senior fellow of FIIG. And we're very delighted to have you here today, Michael. Thanks for joining us. I understand you've just come back from China. Can you tell us a little bit about what you were doing there?
Thanks, Liz, and thanks so much to FIIG for the very kind invitation to talk with you today. The recent trip to China was about the issues we're talking about today: portfolio construction, the rise of the middle class, the ageing of the population. And one of the things that's sort of really interesting theme, I think, in China is this idea that the country may get old before it gets rich. So there's an important debate there about population ageing, portfolio construction, and how you think about a sustainable retirement income.
Fantastic. That sounds really interesting. We look forward to hearing a bit more about that. But before we get underway today on the sequencing risk, the worst returns in their worst order webinar, just a little bit of housekeeping. If you haven't joined us for a webinar before, on the top right-hand corner there should be an orange arrow and a panel. If you can't see the panel, please click the orange arrow and you'll see about midway down, maybe a bit more like 3/4 of the way down, there's questions there. If you expand that, you can key in a question for Dr. Drew during the presentation. Now, we're really in for a treat today. I've heard this presentation before. There's a lot to get through. Please send in your questions. I'm not sure how many we'll answer during the presentation because I won't want to disrupt Michael's flow too much. But please send them in and we'll attempt to answer them at the end of the seminar. But for now, I'll hand over to Michael. Thanks very much, Michael.
Thanks again, Liz. The background to this research really came from experience from the field where I had an involvement with a very large super fund that had, as part of its brief, police officers that looked after in its charter. And during the global financial crisis, we had a situation where we had police officers. This is a story about two police officers specifically, where one police officer, because of the statutory retirement age, retired just prior to the global financial crisis and then switched into an allocated pension. The other police officer, again 18 months younger than the first police officer, retired 18 months into the global financial crisis. And when we did some analysis on this, these two police officers, they had the same rank, both senior sergeant, both had very similar human capital, for want of a better word. They had very similar career experiences, similar contributions to super. But because with the timing or the path dependency of returns, their actual annuity equivalent value, their retirement income, was different by about 30%. And so for us, it really was the living case study on the role of the order of returns or the path of returns or the sequence of returns in the way we think about the analysis. So for us, this work is really about trying to think through how we think about the worst returns in their worst order. And I'm really interested in this research to hear the experiences of investors, because we tend to think about this problem as sort of time-weighted or average returns. And as we're going to talk about today, I remember my grandfather taking me fishing as a young boy, and he'd say something like, you don't cross a river because the average depth is 3 feet. And that took me a while to sort of work out what that actually meant. And this is really the sort of, if you will, the metaphor for today, that you could imagine this sort of group of baby boomers who have experienced some very good paths of returns up into the sort of late 90s, into the sort of 2000 range, and then they've had the 9/11 experience, the dot-com bubble, subprime mortgages, the global financial crisis, and now for their trouble, the sovereign debt crisis. So we're interested in how the path of returns impacts the outcome for investors. And this work, we're very thankful, was supported by our colleagues at FIIG, and it's joint work with my colleagues Anoop Basu and Brett Duran. So what we wanted to talk about today was 4 themes around what sequencing risk actually is, where this risk is going, how do you think about, say, measuring this risk, and perhaps the controversial area is sort of how you try and manage this risk. And I think from our sort of experience that the management piece is really where the rubber is on the road, and is really the area for debate, both for today and even in larger forums like the FSI report that's being released later this week. Mr. Murray and his colleagues have certainly identified gaps in the retirement income space, and how you think about managing sequencing risk is part of that larger conversation. So let's start off with what this actually is, and there's a number of really important definitions here that we'll talk about, but essentially this is a story about how sequencing risk or the path dependency can affect investors when they're drawing on income. And I understand today there's a number of folks in the SMSF framework who are living this on a daily basis. This is not an academic exercise. This is the challenge of building robust portfolios for a sustainable income stream in retirement. Jones and others say that investors in any phase are vulnerable to the market's gyrations and unfortunate market timing. And of course, sequencing risk is very important, I think, for your listeners today, in that when you are withdrawing in that post-retirement phase, how the path of returns or the order of returns can be extremely impactful on how they can manage their income risk, the real income that they earn, inflation-adjusted return in retirement, and also the larger matter of longevity risk. This for us is actually really nicely brought together in this slide, where we've been doing this presentation now for some time, and when we ask questions of advisors or clients or investors, we ask questions like, what's more important? Is it the rate of return, or is it the order of returns that's important? And typically, even in China, around about 80% of people tend to answer that it's the rate of return that's the important part of the investment equation. And what we're going to do today is perhaps challenge some of that thinking, Liz, and think about the sequence of returns, how the order, the path of returns is every bit as important as the actual average. So our working definition for today is, how does the worst returns in their worst order impact retirement outcomes? So we have to get this started. So we're going to start with someone that was born, it's got here DC member, that's an international term for defined contribution or superannuation fund member, someone that bears the risk, the investment risk of their retirement savings. So we're going to take someone that's born in 1987. Believe it or not, Liz, there are people born in 1987. I teach some of these people. They vote, they drive cars. It's incredible. All I remember about 87 is the crash, but that's perhaps showing my age. They commenced work at 25, and we've kicked this person's career off in 2012, and they're working until 2052. And today, there's no sort of black boxes here. We're just going to use history as a guide. So we've got this terrific data that is provided by Dimson, Marsh and Staunton, that looks at stocks and bonds and bills back, say, 112 years. So a really nice long-run sample of data that's used to think about long-run returns from stocks and bonds and cash or bills. This person has a zero starting balance in their superannuation account, and their starting salary is about $41,500. So we just took a simple starting salary from the My Career website. I think it's really important at this juncture that we do make the comment that you know, gender and retirement outcomes for men and women, as we know, are vastly different. So we have made a heroic assumption here that this superannuant has a salary growth rate of 4%. If you're interested in this, Liz, I'm more than happy to provide some research we've done on gender differences in superannuation and how career breaks can impact their retirement outcomes.
I'm definitely interested because I certainly had a career break for my children, so yes, definitely, that would be great.
But just to, as you can sort of imagine with these sort of studies, we need to set up a sort of a straw person or a straw man, for want of a better term, straw woman. We need to just think about some cash flows. So importantly today, we're not going to change any of these assumptions. So the contributions being made, the salary growth rate, what this sort of hypothetical fund member is putting into super is constant for every single piece of the analysis. So going back to our police officer story, we're going to have the same contributions made at the same time over the working life. So this is just a simple profile of this person's contributions made over time. So over this period of 40 years of working life, the contribution total is about $373,000. And you can see they're just making simple annual contributions. You can see the impact of the compounding through their working life. Again, you can do studies on, as I said earlier, women in super, gender outcomes in super. We're doing some work on the casualisation of the labour market in super, different careers in super. But just for today, this is a very vanilla contribution profile. So what we do here is just to give you a flavour of why this debate is so important, is we just take the actual returns from a fund. And it's very important that we set this up, that what we're doing here is we've set up a 70-30 portfolio. So 70% in growth and 30% in cash and bills. And it's important that we don't change that asset allocation through the study. And the reason we do that is as you know, around about 4 out of 5 Australians are in the default option in their superannuation fund. And of that, around about 91% of funds, those default options, are 70-30 or quite growth in nature. So we just need to pick an asset allocation that is representative of someone starting, say, in the superannuation savings, say today, they decide just to go into the default option and they keep that default option at 70-30. So throughout this study, we do keep that asset allocation constant. And for another day, we can certainly talk about more dynamic approaches to that asset allocation through time. But when we survey folks in super, they do tend to have this sort of growth bias, this sort of 60-40, 70-30 type bias, and certainly that's what we're going to remain constant through this work today. So we build this portfolio and we look at returns back from 1900 through to today. And as you can see in Table 3, we've actually got the returns that a 70-30 portfolio delivered in 1972 was about 14%, and then as we work our way down to the end of 2011, the return was 3%. You can see some periods of history there, 87, dot-com bubble, GFC. You can see the impacts of those things on the slide. Then we can do some very simple things. We can reverse them. We can put them in their best order, so we have the bad returns early and the good returns late, and their worst order is where you have actually the best returns early and the worst returns late. Now the important thing for your listeners today is the fact that, and apologies Liz, we're going to do a little bit of math, but you've got sort of the mean or the average return and the risk or the volatility or the standard deviation, and what's critical to note is all of those things remain constant regardless of whether you change the order, ascending order, descending order, the actual average annual return and the average risk remain identical. So what we can then do is start to play with the order just to give folks an initial feel for how the ordering can impact return outcomes. So we're going to visualise this now. So here in the blue line is our wealth outcome from the actual returns for this investor from 1970 through to 2011, comes in at about $4 million. If we just reverse the path, so we don't do much here except reverse the path, same average annual return, same average annual risk, we can see a $1.4 million difference just by reversing the order of returns. Then if we take the very significant best and worst, we can get some incredible outcomes where if you have the best returns early and the worst returns late, that comes through at about $1.4 million. If you put all the good returns when there's the largest amount of money at risk, you can see that that blows out to some quite unbelievable number. But I think what's important here is that just to set up the argument today, same cash flows, so we haven't changed the cash flows here. We've taken a single 40-year period where you have the actual experienced order of returns, we've reversed the returns, then we've played with them and put them from worst to best and best to worst. But it's very important when your listeners today are thinking about their investments, how the average return and the average standard deviation is identical for all of those paths that we've identified today. So how does this work and why is it a problem? So you can see here we've just visualised some contributions, and we make contributions regularly through our savings lives, and we've got time here on the horizontal or x-axis. And as you can see, if you have a negative return very early in your life, you can withstand that. So, you know, for 25-year-olds who lived through the GFC, did that hurt? Yeah, it hurt, but they were making contributions which probably actually at the end of the year resulted in them having a higher balance than they did at the start. But what if we were to do this? What if we took that big contribution and we actually put the big negative return at the end of the period? And as you can see, this then sort of contaminates, if you will, all of those earlier contributions made. So one of the things that we're really learning in this debate is how we frame success in retirement investing is incredibly important. That we can spend many hours looking at averages, standard deviations, but we also need to really pay cognizance to the dollar-weighted or money-weighted outcome, which I think is again the part of this success, how you frame success as a sustainable level of retirement income. Okay. So what we do here is we just take our investor that started at 25, and just to get a feel for, and this is really, I suppose, Einstein's comment about the beauty of compounding. But as you can see, the first 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, the first 10 years of contributions account for about 2/3 of the total nest egg. So one of the things, Liz, that's incredibly important in this debate is that the average Australian will accumulate about half of their superannuation balance in the last 10 years of their savings life. And that's an incredibly important parameter to think about, that about half of the total nest egg in retirement is accumulated in that last 10 years.
So they're the most critical, obviously.
Absolutely,
yep.
And when we should be thinking critically about asset allocation and how we engage with asset allocation when the largest amount of money is at risk. Such a critical decision that drives the sustainability of retirement outcomes. So what we can find here is what we call the portfolio size effect, and as an academic we've written papers on this in the Journal of Portfolio Management, but it's really just a slogan or a shorthand to think about when in your savings life the contributions you make to super are 50% or less than the impact of the investment returns. So in this particular path, many Australians will be in their late 30s, early 40s, and the actual investment returns will start to dwarf the actual contribution rate. And one of the things I think is really important again in this conversation is how do we ensure folks are thinking about, the critical nature of asset allocation. And as I'm going to show in a few minutes' time, there's kind of like an 80-20 principle here, where 80% of this story comes from the return path and 20% from the contributions, particularly in those later years. And then for those of your listeners today who are in the post-retirement phase, you can imagine a mirror to this set of slides where they're actually drawing on this money through 65, 70, 75. So they're looking at a mirror of this problem. The problem doesn't go away when you retire. You've still got the largest amount of money at risk, or the retirement savings are at their zenith at that critical time. Okay. So what we do here is we just give a feel for, again, just to set this up, we have a hypothetical investor. They're 25, they started work recently, and we just take 40-year paths from history in our little 70-30 fund to get a sense of, what is the impact of the contributions to the total portfolio. That's what's on the vertical or y-axis. And many of you would have read that famous book, The Pareto Principle, or the 80-20 Rule. This is a classic, absolutely classic example of the 80-20 rule. So where you can see the investor hitting, say, age 55, 60, 65, you can see that contributions generally account for about 20%, and the actual return paths are contributing about 80%. So again, there's this sort of 80-20 principle, and you've probably heard me say this before publicly. Do we make sure as SMSF trustees and investors that we're spending about 8 minutes out of every 10 on asset allocation? Do we really focus on the things that matter? Do we really build robust portfolios that can help us manage this volatility through this critical retirement risk zone, this sort of zone where you are converting retirement savings into retirement income? Really, really critical. And unfortunately, because of the complexities of this, we tend to find people focus more on the asset selection decision. We want to make sure in this sort of conversation today we're thinking about the asset allocation as well.
Or even return, Michael. How many investors concentrate on return as opposed to the underlying risk and what that volatility could mean to their plans?
Yeah, absolutely. I mean, I had the great pleasure of meeting Clive Granger, the late Clive Granger, the Nobel Prize winner in economics, and he talked a lot about this, where unfortunately there is good risk and there is bad risk. But most of us sort of using behavioural finance, we're learning that people tend to zero in on a target rate of return.
Yes.
If they get that or a little bit more, they're happy. If they miss the target or it's less than zero, they get very, very unhappy. So we even find behaviourally we struggle to handle both reward and risk.
Yes.
We tend to it's quite complex to have it in two dimensions. And if we think about what we're going to talk about today, we actually add a third dimension, which is correlation. So you can imagine the behavioural finance stuff is showing us that, well, for instance, Liz, why do Ponzi schemes work? Because people promise this return, and people can quickly use a heuristic or a mental shortcut that says, okay, if I can get a 10% return, my money will double quickly. So, we tend to even, when you see even research that's done on Ponzi schemes, people tend to get hooked into the return.
It's the number all the time,
it's
isn't
the number.
it? It's the number.
Yeah. And this is even a larger sort of debate about what's your number.
Yes.
So, I remember my parents retiring on the Friday, and they'd never had so much money in their self-managed super fund before. And my mum was a hairdresser and my dad was a Woolies manager. And they thought this was sort of, the pot of gold. And then on the Monday, they had to convert it into a retirement income stream and suddenly felt, relatively poor again. It's my inheritance, everyone. That's all I'm worried about. I've got a fiduciary duty. Anyway, for another day. But no, it's a great question you ask about how we frame success and how we tend to, this is some of the great contributions of behavioural finance, how we're learning more and more about how people sort of zero in and they use mental shortcuts, and that's why they zoom in on the number. Yeah, all right. So what we want to take this debate now is to think about what drives sequencing risk, and dare I say it, I think this is a really interesting part of the discussion because it's got a little bit of capital market history, and I hope your listeners today find this somewhat interesting to see where this has gone and where this is going. If you're wondering why you're getting more grey hairs as you get older, it's not genetic or it's not physiological, it's this problem. As an investor around the world, we're seeing equity volatility rise in the last sort of 100 years. So this, Liz, is just a rolling 3-year Australian equity volatility chart. And as you can see, it's actually been rising through time. So we're getting good returns, but we're actually taking on quite a bit of risk to get those returns. And for many people perhaps on the line today, you can see that volatility actually washed out quite dramatically in that sort of late 90s, sort of early 2000 period. And we're seeing again volatility lowering around the world, which is making people, of course, quite nervous at the moment about the behaviour of volatility. So equity returns, whilst good, you are carrying some roller coaster with that. The risk profile over the last 112 years has actually gone up. We can also think about the distribution of returns. Now, dare I do this on a Tuesday lunchtime, but I'm going to do a histogram. And I just want to show you the return paths from these portfolios over the last 112 years. And in the sort of early period, say from 1900 into the sort of 1930s, you can see returns generally positive, but the impact of the 1929 stock market crash there as well. Then in the sort of middle of the last century, you can see returns again quite strong, but relatively low level of risk. And this to me is sort of the, dare I say, the Oprah Winfrey kind of light bulb aha moment in this whole presentation today. The blue is sort of our experience of investing sort of from the 70s through to today. And you can see the kind of the tails of the distribution, or the, the positive years in the early 90s, 1985, a particularly good year, and then in the left side, 1973, 2008, 94, 74. So we've had what's called, and you've probably come across this in your debates here at FIIG, these black swans, or as Nassim Taleb calls them, these sort of big negative events that occur in markets, and they occur far too frequently than what standard statistical theory would think they would. Now, that's a lot of math jargon. Let me put it to you in a more practical way. I started work in 1987, so in my career I've had the 87 crash, I've had the property market correction in 91, the bond market correction in 94, the Asian financial crisis in 97, Russia default crisis in 98, 9/11, subprime, GFC, sovereign debt crisis. So in my kind of working life, something that should only happen rarely, every sort of 2 or 3 years, we have some sort of crisis that no one was expecting, and no one thought was mathematically possible. So
that's quite sad, Michael. I'm looking at you counting on your hands. That's 9 events, and I have to say my working life started the same year yours did. So I'm exactly on par with you. Nine big events. Okay.
And I'm sure some of your listeners today were, I don't know, I'm trying to think of a nice way of saying it, taking it in the neck, but really felt the impact of those events in the 70s as well. Inflation, the oil price shocks. So I suppose why I like this sort of, it's a histogram and it's a bit nerdy. I'm fearful for what people are typing into the computer now, but it is very nerdy. But anyway, I think it is nice though just to see that capital market history and those sort of different epochs of returns.
I think it's interesting too that the most volatile years have been the most recent ones. So are we going into a greater volatility, more volatile markets because communication's so fast perhaps, or there's mandates, or there's people selling at the, it's interesting, times have changed and life's changed, where once we read about it in a weekly newspaper, now it's, happening, we're getting tweets or messages instantly, so people are making much quicker decisions.
Yeah, and I think that's part of it. I also think, this is again for another day, but sort of the kind of historic levels of indebtedness around the world, particularly in sovereigns, and the impact at some point that that's going to have with an ageing population. Again, I think you're absolutely right. There's a range of technological, demographic, economic factors that are playing into this. But again, as we saw in that sort of earlier diagram, volatility has been rising over the century. Okay. So what we want to do here is just give you a feel for how, as we go through history, how this impacts this investor. So again, in these diagrams, it's the same 25-year-old, same contributions, all invested in a 70-30 style portfolio. So we can just we can show you from the paths from 1939 to 1970 that we've got returns that are quite closely clustered together. The reason why we're all getting the grey hairs is that as we've just had the discussion about the latter part of the century, the blue line is what's occurred in more recent times. So you can see the best path of returns was those returns leading up to someone retiring in 2000. The worst path of returns were for folks who retired in 1974. Some people, when we've showed this diagram, have said to me, but hang on, isn't the global financial crisis the worst possible paths that you could get? And the answer to that is actually no. The experience in the 1970s was worse than the experience during the global financial crisis. So that's probably a little bit depressing. It can get worse. But I think, again, an important lesson from capital market history. So you can see the sort of lesson here is that for folks who get return paths similar to that ended in the 1939 or 1970 period, they get a mean return of about 2.6 million, and the standard deviation of outcome is very low. The volatility is very low at 340,000, and the range is about 1.3 million. The price, if you will, of having higher volatility but higher equity returns has been that while the average is higher, we got both the best and the worst paths in the second half of the century. So again, this problem of you can look at one metric, the average, but when you actually look at the dispersion or the risk or the standard deviation, you get a very, very different sort of picture. And that's the kind of world we're living in at the moment. So we're trying to work out in this more volatile world how best to manage this sequencing or path dependency.
It's great. No, fantastic. I find it fascinating that the differences can be so huge. They're absolutely huge, and of course something to be very well aware of as we approach retirement. As you say, those critical years where you have your peak funds and how you invest those, and really try to determine how long you're going to live,
yep,
and how much money you're going to need to live the life you want to live well, and how you invest that. It's very serious problems for all of us, I think.
Yeah, and you're absolutely right. I mean, you know, if you were to work 40 years and in 40 years' time have $1 million in your account, and this is just a hypothetical investor, you know that there's no longevity solution that can take the bad things away. If you get the kind of paths like the 2000s, sort of up to the 2000 period, this is the land of milk and honey, happy days. But what's fascinating is that, again, there's no magic tricks here. This is the same cash flow profile, a very basic 70% growth, 30% defensive allocation, and just using history as a guide.
But even if you have that best run and you retire in 2000, you then have the issue of how to protect your capital, don't you, and ensure your income over when you retire, which I think is actually worse in that you don't have any backup or income coming into, if things don't go quite to plan. So
yeah, it's a very good point, and again, I think we said before something about mirrors. Yes. Your colleagues on the call today could just put a mirror to that and pick up exactly on your point. We have another paper that looks at that, Liz, and maybe that's for another, most safe withdrawal rates, maybe that's for another day.
I think that's a great another day topic.
Okay. So how do we measure this? When's it a problem? How do we think about the problem? Now, this is just a heat map, and we like doing heat maps because it just visualises the challenge. It's a classic academic slide. It's small in font. You can't read it. I can say what I want about it. No, I'm being a bit cheeky there. So what we do is we look at paths right at the top of the screen from 1900 through to 1939, and then we simply roll another 40 years forward, so 1901 to 1940. What you would like to see is lots of green towards the end of each of those slices. So that would be an above mean return from our 70-30 fund, and what you'd really, really like to see is some blue in there as well, because that means it's very, very good returns, more than 2 standard deviations above the average. You really want to avoid a lot of yellow towards the end. These are the below mean returns and of course the red. And the red points are the obvious ones like the oil price shocks, the 29 period, the Great Depression period, and again those sort of periods where we think about quite extreme returns on the downside. So what we can do is we can show you here the best and worst returns. So we've just animated a slice of these returns. As I said, the worst returns were from 1935 to 1974, and as you can see there's a lot of yellow towards the end and then the red and then another yellow outcome. So we can see for those sort of investors, if they were to experience that sort of path, the average annual return was about 8.6% per annum and the terminal wealth about 1.4 million. And as discussed, the best path ended in 2000, where you've got quite a consistent run of green, where you have the largest amount of money at risk, and that came in at 6.7 million. When we've shown this around the country or even overseas, people are agog at the difference. Same person, same contribution, same asset allocation, just using history as a guide. One can sort of look forward to, the kind of happy days, endless summers, cycling through Gay Perry, all the stuff that's on the television ads about retirement and superannuation. The other one is, with the greatest of respect, probably replacing brand level dog, brand label dog food. I mean, it's a really quite depressing outcome to think that you've worked all of those years to have that kind of balance at the end. So it's provocative because it gets people to think about, hang on, there is something bigger here than the average. There's this sequence issue. So decade by decade returns matters. I'm sure some of your listeners today follow Meb Faber, as I do, on Twitter and his blog. And he even had a tweet, which we've retweeted last night, on how the starting point matters.
Yes.
The valuation matters and the starting point absolutely matters.
Yeah. Just before you go on there, it's interesting that 1974, the red year, the red dot right at the end, if you were planning to retire, had you progressively taken risk off the table prior to that, obviously it wouldn't have been as damaging right at the very end and at the worst point. But of course we never know what the worst point is, or we can't predict that. So
it's such a great question that leads us to think about life cycle, life stage, the epochs of our sort of retirement savings journey.
Yep.
It also gets us really to sharpen, I think, Liz, our thinking on what success is in this business. That it's something more than beating a benchmark or peer returns. It's about matching a liability in retirement. And we're doing a lot of work on this at the moment. We're going to present something on this in Melbourne next week on aged care liabilities, medical care liability, the impact of inflation in retirement, and how you build portfolios to think about matching to those liabilities. I'm sure many folks listening today have a bequest motive. So again, we're talking about outcomes and outcome-oriented investing, not simply, I got this average return over this period and beat the benchmark.
I've got a couple of questions for you, Michael. So Jeff has asked, in view of the increased volatility, will this affect the standard asset allocations per age between shares and bonds?
Yeah, thanks, Jeff, for the question. Great question. This is an international debate that Australia is starting to pick up on, but if we're having this debate in the US, this webinar in the US today, this whole conversation would be about age cohorts, life cycle or target date investing, how you think about managing the risk profile, given a couple of things, given the amount of money on the table is increasing, given the fact that the largest amount of the impact is the return path, and how you could smooth those returns by incorporating some form of glide path or de-risking informed by the objectives that you're trying to achieve. So I think Jeff's question is absolutely bang on about outcome-oriented investing and how age, and even in retirement, longevity, life expectancy, and how you think about all of those expenses through that journey is also about that kind of epoch. We've been finding there are epochs in retirement. There's an active retirement phase. Retirement isn't sort of homogenous.
No.
It's heterogeneous. So we're even seeing data now that's showing us the different epochs of retirement income and retirement needs.
Of course, because when you just retire, you have the most money, your health is probably the best it's going to be, so that's when you probably spending big on travel and various other expenses. I have, Bob's asked a question. He's asked, what does terminal wealth mean? And he's just querying some of the numbers, the returns of the 1.4 versus 6.7. Do you want to just
so sorry, Bob, great question. Terminal just means at retirement, sorry, so I should have just said at retirement. So terminal wealth is just a way of us sort of locking in that sort of 40-year savings profile. And again, just trying to think through, if we have a standard set of cash inflows and we take different historical return paths, how when applied to that 40 years of contribution, does the $323,000, whatever the number, 340, I can't remember the number, whatever the contributions were standard, and we take different slices of 40 years and we apply it to each of those yearly contributions, how that leads to the different range of outcomes. Great question. And as you said, Liz, terminal's a silly word, we shouldn't use it, because really then you've got another investment journey where you're starting.
Start again.
Starting the retirement.
With a different view, I'm sure. Tom's just said, looking at the 1975 terminal value would be interesting. Red, yellow, then blue in the last 3 years. So.
Yeah. Great question. So, and it's even interesting. Look, like this is the nice bit of this. You can sort of assign sort of capital market history to each of those slices. Maybe. So, who was the question? Was it Tom?
Tom.
Yeah.
It was
so,
Tom. Yeah.
So maybe I'll just show this that may interest Tom. That sort of leads from Tom's question, which is what I thought would be interesting is what if we could find two historical paths that give you the same dollar outcome.
Oh, that's very interesting.
So you know what I mean? So I think that leads from Tom's sort of question, right? So
let's
and we actually did find them. There were two paths, 1903 to 1942. I understand something went on around that 1942 period. My grandfather was involved, and 1939 to 1978. Now, why I think this is interesting and leads from Tom's question is, if I was to ask you, what would you prefer? See these arithmetic returns? This is just the average annual returns. Would you like 8.7% per annum or 9.4% per annum? I think most people would say, I'd like the 9.4.
Absolutely.
Right, that's good, right?
Yeah.
But these actually give you the same end value, bar about $300. So, Liz, if I can give you the $300, we'll just assume that these are the same, bar about $300. And sort of there's a question here about, dare I quote Professor Julius Sumder-Miller, but sort of why is it so, right? And this is kind of why it's so that this is really nice. It leads from Tom's sort of point about different paths and what happens to different sequences. And as you can see, the 1942 path is illustrated in red. And you can see sort of actually quite a smooth path, to be honest with you. The value grows to about 1.9 million. Now we know there's a story after 1942, but we're just here to set up, you know, a period in time. And then you can see with 1978 that this investor late in their accumulation phase, when they're about 60, gets the impact of sort of, you know, the 73, 74 type returns. And you can see the sort of, you know, the yellows and reds there. But then they get this sort of big rally post that period, which rockets it up to the same endpoint. And I think why that's interesting is, what I hope is a small insight from today is how it's almost like we need to have two conversations as investors. We can think about the average return, but then we really, which is interesting and an input, but as investors we really need to think about the dollar-weighted return, the money-weighted return. What is the impact of this return on my portfolio given my investable funds? And this to me is a really important debate we need to have nationally. Is I travel a lot interstate with client work, and I always do the bus shelter test, so looking at the super funds and how they advertise on buses or bus shelters. And one of the things that strikes me, I had a meeting recently with where the marketing of the super fund, the marketers are very happy because in 2014 they can roll off the impact of the global financial crisis on their 5-year returns. So, you know, there really is an important discussion here about how we frame success, how we think about the impact of returns on people's retirement income. Imagine those people drawing, you know, on their retirement income from 2008 versus someone that starts drawing, say, this year, where returns are sort of recovered post. It's a very different equation, and people have different starting points. So I hope that's of interest to the listeners today, this idea of, we tend to talk a lot about the average or the time-weighted return, but, you know, how do we think about that impacting when we put cash flows against it?
And ultimately, those cash flows or that money is going to be used for your lifestyle. So it's the worrying about the cash outcome as opposed to the return up front. So I've got another couple of questions for you. Graham has said, longer-term investments for growth can cope with volatility, but as volatility seems to be increasing, does that mean longer-term has to be even longer?
It's a cracking question. I feel like the crystal ball is somewhere, it needs to be, or the magic 8 ball or something needs to come out to answer that question. It is a terrific question, and it's something, is it Graham that asked that question? Graham, it's a great question. It's, as you know, it's being debated around the world about, have we kind of, with markets running quite hot, have we kind of created a world where expected returns have to be lower because we've sort of factored that in today, that, you know, valuations, particularly in equities around the world, seem to be at quite historically high levels. So Graham, your point is absolutely right. If you see returns run very hard in the short run, you tend to be sort of bringing that return profile forward. And if you believe in some of the Nobel Prize winners' work about mean reversion and long-run returns, then it sounds to me like Graham might be reading some of the work of Jeremy Grantham on sort of, you know, a mean reverting type view of the world. Yeah, that's a very, I'd love to have the answer, Graham, but you're absolutely right. There is a global debate about how we manage and wash out volatility in the post-retirement space to create these sort of sustainable income streams in retirement.
I'm going to let you carry on with your presentation. I've got a few more questions, sure, but I think we'll carry on and then we might ask them at the end.
Sure. All right. So what I thought we would do is just, now we've done the history, we are going to get the supercomputer out here and shuffle the returns. So what we're going to do is sort of, dare I quote Donald Rumsfeld at a FIIG webinar, but I'm going to. We're going to talk about the kind of known unknowns. So we're going to think about, okay, when you've got these historical paths, what if we were to then sample without replace? So what if we were to actually look at different return streams where we keep all the average return, the risk, we keep all of those metrics constant, but how do we think about what's possible? So here is just an example of the bootstrap where we have from 1972 to 2011, we did this example earlier. And then we're just going to reorder the returns. So we're going to put these in different orders, same annual return profiles from our 70-30 fund, but do the reordering. And you can see the different end result. We do that again. In actual fact, we're going to do this 10,000 times for all of these different paths. So we're going to have about 10,000 simulations for each of the 40-year paths, and we're going to have about 30 million data points. So this is sort of the big data type moment. And the reason we do this is history is a terrific guide and I think brings up some interesting points, but also it's only, you know, 73 paths. So we want to think about what if we sort of reordered this and get a feel for what's perhaps possible. This perhaps is the sort of the crescendo of the presentation, in that the black line represents if our hypothetical investor started at 25, contributed the profile that we showed earlier, kept a 70-30 asset allocation, what would their end value be? And then what we do is we run these simulations to give you a feel for what's actually possible. And as we do that, like any kind of model, you want to make sure there's some sort of reality here, some history here. So to give you some comfort, 1974 was an example of where you actually got, as an investor, a return series in the worst 10% of possible outcomes. So really nasty series of returns for someone over that 40-year period. where 2000 was, absolutely fantastic ordering of returns and gave you something in the 10% best. So history has shown that we've had episodes of this. What I think is sort of more important, though, believe it or not, is on the right-hand side we've got this little RWR, which is the retirement wealth ratio. And this is becoming more and more popular in retirement income circles to think about a multiple of your final salary to your nest egg. So for instance, if you had a retirement wealth ratio of 10, you would have 10 times your final salary accumulated as your retirement savings nest egg. So there's a debate about what you need as a retirement wealth ratio. Is it 15? Is it 20? There's a debate. But the nice thing about the retirement wealth ratio is that regardless of people's starting points, it's like an anchor that they can use to think about, okay, that's sort of where I've got to in terms of my final year's salary before I retire. So what this is really trying to bring out is, again, just this idea that when we invest, we tend to, as you said very, very eloquently, Liz, we tend to focus on the number. And this is sort of showing that we need to absolutely focus on the number, need to focus on the risk, but also need to think about the path dependency of that risk. How does this path of returns impact the sustainability of my portfolio in retirement? Is this the kind of fan of uncertainty that I'm comfortable with, or do I want to bring that fan of uncertainty back, which leads to conversations about life cycle or life stage or age-informed asset allocation? Yeah? It even leads to, in the post-retirement sphere, perhaps conversations about buckets and bucket investing. So, this is my income bucket, this is my age and healthcare bucket, this is my bequest motive bucket, this is my sort of inflation hedge bucket. So, all of this sounds really tricky. I remember my grandmother, I think the behavioural finance term is mental accounting. My grandmother, God bless her, she would use jars, and she would put money. It's just a fancy way of thinking about jars, right? So we have new terminology for this stuff. It's not like people haven't thought of this before. It's just thinking about sort of, if we just leave it to the whim of the market. And I think as some of the comments today have shown, if you're going to leave this pool of money for another 30 years in retirement and don't need to touch it, this is completely academic discussion. You would leave it and it would run, you know what I mean, and you would be putting the balance of time on your side.
Yes.
This is a conversation for people who need to start drawing on the money from day one.
Yes.
Yeah, so that's a different investment horizon.
Yep.
So we're going from 30 years to, I need this sort of for the groceries next fortnight.
Yep.
Yeah, so again, the horizon is so critically important in this work. So maybe this sort of leads to where some of these questions perhaps have been terrific, to think about, well, how do we manage this stuff? And the work of Nobel Prize winner Robert Merton's important, and so is another Nobel Prize winner, Sir Samuelson, is important in this debate about sort of life cycle approaches to this risk. I think again, behavioural finance has something to say about this, where sometimes we think of retirement portfolios as a single portfolio, where the more research and work we're doing, we're learning that retirement liabilities have very different dates, and the timing of some of them is completely random. Yep. So there are things we know, right? There are, the groceries and the utilities, regular cash flow requirements that we know. When you actually look at the data on aged care and medical care, it becomes far more difficult to really model and pick with certainty how long we are living longer. So I think we've been talking about this recently, where Australia has recently joined only 3 other countries in the world where both men and women have a life expectancy beyond 80. So we know generally that's going up. We also know that if you tend to hit your life expectancy, you tend to live longer. So
But I say to people now, how many of you know someone in their 90s? I think everyone knows someone in their 90s.
Yeah.
I've got my grandmother's brother who's 91 and his wife's 93. I mean, how fantastic. They live a great life and are active still. So.
And that's the thing, right, is that, you know, breaking down some of those retirement liabilities, I think, is just so incredibly important to inform portfolio construction. There are going to be times where some of those horizons are quite short, which naturally lead to conversations about defensive assets, bonds, the role of bills, all of those sort of securities to match the liability. Then there are other conversations which need to be had about inflation. I saw something, we tweeted it this morning, where, I hope I'm quoting this correctly, AARP, which is a big US aging agency that looks after advocacy for older Americans, said that the price of brand prescription medicines in the US last year went up 13%.
Wow.
So there's a conversation there about inflation. So how do you look at investments to sort of think about inflation-linked or inflation hedging returns? Equities are part of the story as well, but we know that with the volatility, we need to have the horizons right to do that. So, you know, yeah, there's a really, I think what we're sort of hoping to take out of this is a more practical approach to this issue of portfolio construction. What I probably sort of, in terms of the slide, maybe comment on is that sequencing risk is present from the second contribution, or it's present from the second time you withdraw money.
Right.
So, you know, if we just put $1 million away and opened it up in 30 years' time, the order doesn't matter. But when you change the cash flow profile, it absolutely matters, right? So, unfortunately, that's the challenge we face both in the accumulation phase and the retirement income phase, is the cash flow profile is changing, and therefore we have to be sort of really present to this impact and making sure the asset allocation's right. And as you can sort of see, we've talked about the portfolio size effect, that there's even research now showing that you might be slightly more defensive in those sort of early retirement years, but then actually maybe become a little bit more aggressive, almost like a U-shape. So there's even debates internationally about what the asset allocation looks like in the post-retirement phase, and the role of bonds and growth assets and how you think about the matching of liabilities. And that's unfortunately the great challenge is, you know, this is from one of our papers that shows sort of a 3D of the retirement income savings journey. That you can see sort of the impact of this risk really is in the last sort of, you know, 10 or 15 years of your retirement savings journey. So here we've just got 40 years of working life, different return paths, same cash. So, you know, really thinking about what happens and what you do when the largest amount of money is at risk absolutely matters. And, you know, more and more as we progress late in the accumulation and early in the decumulation, that the portfolio becomes very, very sensitive to the asset allocation.
Great.
So we've just done some analysis on, you know, what a GFC-like event would mean for an investor. And so what we've done here is we've just looked at what would happen if we just had one negative return in our working life. So say, for instance, we just accumulate and we have, say, a GFC in the last 5 years of our working life. And that's actually equivalent to 1.5 times our lifetime contributions to superannuation. So this is a slide that's got a lot of attention both here and around the world, is thinking about, again, how a bad timing of returns and what it actually means for sort of, you know, the retirement savings journey and the outcome. And as you can see, there are people who are on the call today, and certainly people who I know have had this kind of profile where unfortunately they've had a big negative GFC-like return in the last 5 years of their working life.
So sorry, Michael, that's at naught, isn't it? Is that naught on the slide?
Zero
is retirement age, and the skin colour, if you like, is the.
This is the challenge of, do you either lower your consumption to make the money last, or do you keep on the consumption pattern and then you face the risk of longevity risk, outliving the asset? So so it's a really difficult and confronting decision where We know we're living longer. We know we have regular, well understood cash flow requirements. But then, and this is the work we're currently doing at the moment, we've got this kind of almost difficult to forecast medical costs, aged care costs. For my sins, literally, as you know, I'm on the board of a private hospital, and we're seeing the data on what folks spend on their healthcare in the last sort of few years of their life. We're seeing huge advances in technology, robotic theatres, and all sorts of technology that's prolonging life. So that costs something. I mean, I know as a director how much a robotic theatre costs, and we need to recover that and get a return on that investment. So it's really fascinating how the technology is booming away. We're living longer, but the cost of that is escalating as well. So again, just another way of thinking about the problem. So maybe this is sort of the whole of life conversation where I think the industry is starting to move, where we're starting to have conversations more about not to the retirement date, but through the retirement date. So really thinking about how you can invest over the life course, how the early retirement years are different to the late retirement years, how, as you said, Liz, we're really picking up on different epochs of retirement decision making, and what folks are doing early in those retirement years. Just from a household perspective, we're carrying, as a country, we're carrying more debt into retirement than we have in previous generations. So that's another interesting sort of household balance sheet issue.
Well, actually, I thought I'd read somewhere that apparently 25% of people on retirement have to pay off their mortgage with their lump sum. So that's a big chunk out of your living expenses before you do anything else. And of course, they don't want to change their address or downsize.
Sure.
That's very valid.
And there's a huge debate, and this is beyond today, about the role of the family home, the quest motive. Is the family home a hedge for longevity risk? So I think there's going to be more debate in this country about the role of the family home. Dare I say it, I'm sure your listeners have also picked up on, I thought reverse mortgages were that seemed to die out, but I've seen recently that starting to bubble up again. That conversation in the US is a huge push on reverse mortgage type structures. So so there's a really fascinating conversation about thinking through, not simply to the retirement date, but through the retirement date, and leads to some really important portfolio decisions as well. Mm-hmm. So this is sort of one of the earlier questions about life cycle and glide paths, where this is sort of the idea that would you sort of de-risk through the late accumulation phase, and this is absolutely live, this discussion. So a number of industry funds in Australia have taken up this kind of life cycle approach. If you think about when we look at data from SMSF folks, we know that they tend to inform a lot of decisions based on their age. So there's quite a dynamic asset allocation within the SMSF sector. Yes. So it's interesting how the SMSF folks have really led, I think, a lot of this thinking and implementation, where they think about their life stage, their life course, their life journey, and they think about their whole household balance sheet in a holistic way, and how they put together their portfolio construction. So I suppose what we wanted to do is just share with you some work that we're currently doing in this area. And what we've tried to do is think about a dynamic approach to the problem. So if you're at the target or above target, would you take a bit of risk off? And if you're below the retirement income target, would you put the risk on? And we're actually just showing here that us and other researchers around the world are providing evidence to show that an outcome or target-informed approach to asset allocation is absolutely critical. That it incorporates the risk that you're trying to manage and the outcome you're trying to achieve. So unfortunately, much of, which has sort of been a recurrent theme in our discussion today, much of how the industry thinks about the problem is about the number.
Yes.
Where I think what we've been talking about today is the outcome. The number is an input to the outcome. Being clear on the outcome, managing to the outcome. Okay, if I need a buffer of, pick a number, 3 years of retirement income. If we built a portfolio on that, it would look very different to an inflation hedging portfolio over 25 years.
Yes.
So really we're seeing around the world the rise and rise of outcome or goals-based investing, where retirees are being very, very specific about the liability and how components of their portfolio are built to match that liability. So I think that's a really interesting way of thinking about the problem. Now I'm going to embarrass myself here. I was an excellent junior cricketer, Liz. Sorry.
I never knew.
No, neither did I. I got man of the I got team awards, highest batting average, players player, really fantastic in the first 11.
Congratulations.
Thank you. I appreciate that. But as my wife, who has a PhD in psychology, likes to say, and you do know, Michael, your team never won a game, and your batting average was 23. And I tell that story in a very self-deprecating way to illustrate this point. This is this point on the slide about what is the right measure of success. It's got to be something more than on buses and in bus shelters. I think it's far more personal and far more heterogeneous. It's not some homogenous sort of vanilla outcome. If I've learned anything in this journey is that if you thought accumulating money for retirement was hard, wait till you have to spend the money. That's actually the hard bit, right?
Yeah.
Because we have very, very individual journeys in retirement, different aspirations, different health. My business partner, Dr. Adam Walk, is a chairman of a aged care facility, and he tells this story where you see folks with advanced dementia come in, and the family's extremely worried about them passing and their health, and they get incredibly good care. They live until their late 90s. So really this is a very personal journey, and there's a range of risks here. And this might be strange for a finance professor to say this, that are much, much larger than the investment piece.
Yes.
The kind of activity, cognitive, there's a range of issues here. Social interactivity. These, to me, are the outcomes. Yeah. And how do we build portfolios, if you will, that are the vehicle to finance, and improve these outcomes. So I think there's a really important mix here between sort of the goal and the portfolio construction. I'll be really keen to get your listeners' comments on that. Okay, so I'm going to tell a little story, and you know that if you fly in a plane, which you and I do far too regularly, that the National Transport Safety Bureau in the US tells us that takeoffs and landings at the time at which the risk of a catastrophic accident is particularly high are considered the most critical phases of a flight.
Right.
And I suppose what I wanted to do was think about the problem in terms of the glide path or a flight plan. That maybe what I hope folks take out of the conversation today is that, and this is the bottom dot point, anything deterministic is risky. Any straight line is risky. That when we want our pilots to, when they're coming into land, take into account atmospheric conditions, wind shears, and make the adjustments to have the safe landing. And that to me is one of the huge challenges in this business is ultimately individuals will know their household liabilities better than anyone else, and how do we then ensure that we are building portfolios that get them that sort of safe landing. And safe for some people is very different to safe for other people. I have one son who is highly risk averse, the other son who seems to be risk seeking, right? And they're only young boys, but their personalities are very, very different. And I think we know this about risk now, that risk is very personal. It's sort of in the eye of the beholder. And so again, what can we learn from things like aviation, the safe landing of planes? And to me, the learning is we have to be sort of dynamic and informed by the goal. And to me, when we buy that plane ticket to Melbourne, if the headwind's against us, we know we're still getting to Melbourne. We don't land in sort of Sydney. Or if there's a tailwind, we don't blow down to sort of Tasmania. So I think it's sort of interesting how we can learn sort of from other industries to think about practical considerations in portfolio construction.
And obviously, like a self-managed super fund investor, a trustee, is much more in tune with their own needs. So I think they're on the front foot to start.
Yeah.
They know what their goals are. They're better at adjusting as opposed to being an investor in a managed fund or a large superannuation fund where they're really just doing their best to try and get the returns for a very broad number of investors. Of course, there's a number of them now looking at the life cycle investing, which I think is a great way forward. But I think very much most of the people today will be self-managed super funds, or indeed there'll be advisors to those investors.
Yeah, and look, this is the unscientific part of the discussion, Liz. How you just described the folks in self-managed super funds. I mean, we need to do a study on this, but this is my sort of working hypothesis that these sound like people who are incredibly engaged, who are successful, educated. My hunch is they will actually have higher longevity risk than people outside of SMSF. So I think this is even more critical. I mean, that's an unscientific, but if you think about longevity studies around the world, we know things like healthcare, education, a whole range of these factors are accretive to the lifespan. My kind of suspicion is that many folks in self-managed super funds would tick a lot of those boxes. So I don't know if you agree.
I think I do. I do. They're engaged. They're intelligent. They want to learn. Yeah, I think for sure. We are rolling on with the time here now, and I do have some questions, but I think I'll just let Michael finish the presentation, and then we'll chat a bit more because it's so interesting. Thank you for spending the time with us today, Michael.
Thanks for the invitation. Look, so I suppose we're a bit concerned that the global debate on this issue is largely centred on fees, and I mean fees are incredibly important. Don't get me wrong. I'm absolutely in the public square and published on the detrimental impact of fees. So, but I think fees are a part of this conversation where, I wonder why we're not talking more about this stuff, about clarity of objective, understanding this portfolio size effect. Are we sufficiently dynamic? Now, when I use the word dynamic, I'm not talking about punting stocks and day trading. Not at all. I'm talking more about are we adjusting our asset allocation informed by the outcomes we're trying to achieve, that we're constantly looking at tipping the balance of probabilities in our favour to achieve those objectives. I think we are missing sometimes the point that, particularly in retirement, finite time doesn't go on forever, that it is finite, and that's a little bit depressing to talk about, but there is a finite time horizon. But I'm not necessarily just talking about death. I'm talking about our income needs, or our aged care needs, or our healthcare. A whole range of different time horizons, and that's what makes this hard. I mean, if we could build a product that took away all the bad things, that'd be terrific. But I had the great honour of meeting and having dinner with Bill Sharp, the Nobel Prize winner from Stanford, a few months ago, and he said to me, he said this in the public domain as well, that retirement investing is the single most difficult thing he's ever looked at in his life. Now, Liz, you're a very intelligent person, and I do the best I can. But I think when a Nobel Prize winner, says that, that I think we need to listen to that stuff. That this is it's multifaceted, it's dynamic, it has different horizons. We've got cash flow, cash outflow, asset allocation.
And it's personal. It's personal.
And it's very personal. Yeah, risk is in the eye of the beholder. Yeah. And how do we think about managing different sort of risks during that journey as well? So look, I suppose what I wanted to do is perhaps just conclude with what we're up to, and maybe that'll spark some discussion. But we're doing a lot of work on life cycle investing, as we've talked about today, and we're thinking a lot about different gender, different labour market dynamics. We're doing a lot on liability-driven investing, or that's just another way of saying outcome or goals-based investing. We're asking some questions about, do we need a new inflation rate for retirement? Because the data anecdotally is saying it's something higher than the CPI.
It certainly is if you look at healthcare and, if you're wanting to fund your grandchildren's education, that's where I'm at the moment anyway. It's going up astronomically.
How do we think about the income phase, the retirement, and as you know, we've done some work on the 4% safe withdrawal rule, and we don't think it's that safe, to be perfectly honest with you. So there's an important conversation there. And the kind of stuff we talked about today about how do we move the conversation from averages to outcomes, dollar-weighted return, and perhaps, for another day, for institutional folks thinking about investment committees. But this is the great challenge for SMSFs, is that, they are administrator, chief investment officer. They need to be an actuary to understand the liabilities. It's a really important role that fiduciaries play, and I have recently started my own SMSF, and I now have a far greater appreciation of the roles that these folks, the important role these folks play in the SMSF structures. So maybe I'll leave you with this thought, Liz. This is the theory room, right? That we can, unfortunately, too many academics, including me, have sort of put this slide up too many times and said, look, if you put away 9.5% of your earnings and you earn 7.5% through your life, and you then withdraw no more than 4% per annum in retirement, you never run out of money. So what we thought we would do is actually test this sort of idea. We took this data, and this is actually the real world room. This is not my sons with Crayola going crazy, but this is actually what we're talking about today. This is the sequencing risk on the left-hand side, and then we've just picked a point, say $1 million for a couple. Then we've done sequencing risk on the right-hand side. So this is the kind of challenge we face in terms of the savings journey and the retirement income journey, and how we think about asset allocation during that period. There's some Twitter there. We'd love to get involved in the tweets. So I'm learning how to do the tweets. If you're a LinkedIn person, the other thing is, at the start of this presentation, we've given a link to the report, which is available free of charge if people want to read the report. If they have sleeping disorders, it will help with those sorts of things. But I hope your listeners have enjoyed the discussion today.
I certainly have, and we've had a lot of positive comments coming back from our listeners that, are really saying how well you framed the debate and the number of issues that people have to consider. And of course, wanting copies of the slides and the presentation. The presentation will be available on the website, the recording. I've got just one very lovely question, a couple actually, but this one I particularly want to give to you because I think it's great, and it's from Wayne, who must be an advisor. Thank you very much, Wayne. He said, can you give me 20 words to explain the concept to my clients?
Sure. It's just the worst risks in their worst order. How can we help folks understand the impact of the order of returns? Okay. And to me, as soon as we, and this is for both the SMSF trustees online today and the very important advisors that have the role, the fiduciary role of assisting them, how we think through the outcome framing is incredibly important. So in actual fact, for the advisors here today, I sometimes wonder whether, showing very complex slides of sequencing risk is really the right frame. We tend to talk to our folks about the actual outcome. What's the probability of falling short? What's the impact of a bad path on these outcomes? So it becomes a conversation there about, unfortunately, Liz, I think we've kind of framed success, as you said earlier, as what's your number or what's your pot of gold. And this is not because the industry is bad or that people are silly. It's because we're actually hardwired to do that. It's like the savannah problem. You know what I mean? Like, you see some rustling and you run, right? Like, we are hardwired behaviourally that when we tend to find complex things like this, we tend to use a heuristic, like a mental shortcut, to cut through complex information. And a very quick way of doing that says, $1 million is my number, or
7% return is what I need.
Exactly. Where I really am a big believer in the work of nudge and the idea that you can sort of help people frame things as the outcome. So, really thinking about, well, yes, you can shoot the lights out, but if we keep this asset allocation in this kind of framework, there's a price for that upside potential. It's called downside risk. And, for certain liabilities, that's a trade-off. So I think there is sort of a really important conversation. Richard Thaler is the author of Nudge, Thaler. He's a professor from the University of Chicago, and Nudge is about sort of reframing complex ideas to help people nudge into better decisions. And I think it's a really important piece of work because I think that behavioural finance shows us that, here's a classic one. There's some research coming out of the US that shows that during the global financial crisis, some pension funds there would send people like a bank statement of their retirement savings, like their pot of gold. And another type of pension fund would take the pot of gold and convert it into a sort of projected retirement income stream. People who got the pot of gold bank statement during the GFC tended to then lower risk at the worst possible time. Mm. So they actually took the risk off, say, in March 2009 and crystallised at the bottom. People who had the frame as my retirement income was going down, they actually typically put more money into the fund.
Yeah.
So how we frame things in this business, I think, is absolutely critical.
And of course, it always depends on your timing. If
Yes.
you need the money at that time, you don't have a choice. And I think that's probably what happened in the GFC. You know, the fund managers with redemptions on the, you know, being hit with redemptions didn't have a choice but to sell down assets at the worst possible time.
Yeah. Capitulation risk is massive in this business, in liquidity. Yeah. So I think for me, the question regarding, you know, how do you frame this for clients? This is right at the cutting edge. How we actually think about, it's going to get harder, right? Because when you're saving for retirement, it's a pretty simple anchor, which is sort of like retirement income, so you can convert it relatively simply. It's not simple, but relatively simply. But then when you're dealing with folks on their individual glide paths and their individual liabilities, and they're many and varied, I'm sure advisors here today have had everything from I want to spend the last dollar as I fall into the grave, through to I want to leave 3 houses to my children. You know, advisors are dealing with a spectrum of different investment goals in that decumulation phase. Maybe, and this is sort of perhaps beyond today's discussion, but the people I worry about are the low balance members. You know, where are they going to get the advice in a non-conflicted, you know, way to assist those folks with low balances? But that's for another day.
Michael, thank you so much. I'm looking at the time and appreciate everyone who's still on the call. What a treat it's been to listen to you today and to get us all thinking about so many possibilities for how we save, how we spend, how we allocate our portfolios, and I'm certainly going to go away and listen to the recording again. And I just want to thank you very much for your time. I've got a couple of comments here. Dean, thank you very much. He's written in best FIIG webinar ever. And I think that pretty well sums it up.
That's a benchmark problem.
So thank you all for joining us today. I'm sorry I couldn't get through more of your questions. We would certainly hope to have Michael back at some stage in the future. Thank you very much again, Michael, for joining us. There will be a copy of the recording on the website. And this now concludes the webinar. Good afternoon.